if there wasn't that sudden inflow. So this began in March of 2020. If that hadn't happened, the amount of gold on the COMEX would have fallen to zero very rapidly. And by falling to zero, it means there would have been a force majeure, and then nobody knows what the price of gold would have happened when they went to zero, as anybody that actually did want physical gold would have had to go out onto the market to dealers such as me and try and source it through us. What does that mean? That would have meant 5,000, 10,000, who knows what the price of gold would have peaked at, because of that force majeure.
MikeMaloney, a prominent figure in the financial world, is the CEO and founder of goldsilver.com. In this video, Maloney underscores the significance of sudden gold inflows into the Commodities Exchange, averting a potential depletion of gold reserves and uncertain price fluctuations. He states the fractional reserve nature of the commodities market, where physical gold might become scarce, causing prices to skyrocket. Although the precious metal has dipped below the recent record gold value, it remains up substantially for the year and could surpass previous highs. Distinguished financial analyst Maloney delves into the intricate process of gold flow, focusing on its journey from the U.S. to Switzerland and ultimately to China. He points out the historical trend where the U.S. serves as a primary supplier of gold to Swiss refineries, which then export to China, the largest importer of gold globally. Physical gold demand in China has been robust this year due to continued currency devaluation and economic concerns. China's net gold imports via Hong Kong jumped 40% in March from the previous month, according to Thursday's Hong Kong Census and Statistics Department data. Regarding China's role in the gold market, Maloney emphasizes its significance as an importer and a major producer of gold. He raises questions about the transparency of China's reported gold figures, speculating on the possibility of undisclosed gold reserves accumulating in their central bank. Gold demand from central banks posted its strongest start to any year on record in the first quarter. Central banks added 290 tons of gold to their official holdings in the year's first quarter, with China being the biggest buyer. The People's Bank of China added 27 tons to its gold reserves during the quarter. Furthermore, Maloney is surprised by the unprecedented reversal in gold flow with China becoming a supplier to the U.S. He questions the factors driving this shift and its implications for global gold dynamics, suggesting geopolitical influences may be at play. Now, we present the clips of Mike Maloney's insights from his recent video. Before we continue to delve into this discussion, please subscribe to our channel and activate the bell icon for timely updates.
This is Swiss gold imports. So it's what's being imported to Switzerland. And so it's being exported. And a lot of months, the U.S. is the major supplier to the Swiss gold refineries. So this is coming out of the United States, going to Switzerland. And then where does Switzerland ship that ore and whatever else, lower quality bars that aren't the right hallmark, once they get melted down and re-refined and they're in a brand new bar made by Credit Suisse or Pamp Swiss or one of the other Swiss refineries, where does it go? It all goes to China. They're the largest importer of gold in the world, but people forget that they are also and Alan Hibbard just did a great video on the gold going from west to east and the explosion that is happening in China. But they are by far the world's largest gold producer. Here's the U.S. at 170 tons, China at 370 tons. But that gold typically does not leave China. It stays there. And so when it comes to like the accumulation of their central bank, they're reporting figures and people try and calculate, well, how much gold do they really have? Are they telling us the truth? And what they tell us is the amount that they have that would be possible from the amount that they're importing. This could also be going largely to their central bank stockpile of reserves. And they may or may not be reporting it because we see in their reports, they don't report for several years. And then they suddenly report this new amount. And then they don't report for several years. And so anyway, I want to show you some charts that Alan just made for me this morning. What we've done here is we've taken imports minus exports, so you get the net of whatever. So this shows you the actual flows. So we've combined basically those charts I showed you of Swiss gold imports and exports are all of the different countries for just 1 month on that chart. And I wanted to see the whole history of the US versus China. And so we took the imports minus the exports, which gives us the net, and then we plotted it month by month. And we have the USA in blue here, China in red, and they are on the same scales. So this is very, very comparable data. And what you see here, and what I did, because this starts in basically April, January to March, it's quarterly data, basically. And so the reason I did that is because I wanted to show you these maximums where the US was always a supplier. Always. I couldn't find anything where the US was importing more gold from Switzerland than it was exporting to Switzerland to be refined. And then the Chinese importing from Switzerland. So we're giving it to Switzerland. It gets refined into these deliverable bars for an exchange, and they export to Switzerland. So to China, I mean. So basically, the US is part of the supplier to China, along with all of the other countries that are gold producers around the world. And then suddenly in 2020, March of 2020, and April and May, it all shifts, and China becomes our supplier. This had never happened before. Who had the power to get the Chinese exchanges to stop their deliveries of gold? And you saw that they were still delivering silver, and to get this whole thing to reverse. So we're talking about the China exchanges, and we're talking about the Swiss gold, the gold refineries around the world. Everything seemed to just go into reverse.
MikeMaloney examines Nick Laird's analysis of transparent gold holdings, observing the pandemic's impact on gold flow, which experiences notable fluctuations. In contrast, the silver trade remained relatively stable over the same period. He suggests that emergency measures have influenced these dynamics, particularly evident in the unusual disruption of China's gold imports and exports during the pandemic. According to Nick Laird's data on his website, there were a net 714,000 troy ounces of gold removed, and a net 15.877 million troy ounces of silver were taken out as well from all the world's known depositories, mutual funds, and ETFs during the last 4 weeks. The fact that there have been net withdrawals of these amounts in gold and silver over the last 4 weeks during this big price run shows just how much physical demand for gold there is in London by China. It is suspected that all the silver that has been disappearing from Western ETFs and mutual funds for the last while is now in India, plus other Far East and Middle Eastern countries. Let's get back to the interview.
In a video a couple of weeks ago, I showed you all of the transparent gold holdings. So this is simply the published repositories, mutual funds, and ETFs, the number of ounces that each of them hold. And Nick Laird, if you're out there, I'd really love to see this, or maybe we will do it here. I'll get the data from Nick Laird and we'll update this later and show you. We'll put COMEX on the top, because what it does by putting it on the bottom is all of these have that same jog that the COMEX has. And most of these are just the number of ounces that they're holding just changes very little at a time, not that sudden, huge. And this is the manipulation that I was talking about. And so in the book, I talk about these gold flows, and I show these. There's a couple of charts. Now, this chapter, I was just going to call a special insert and not even call it a chapter. But it was so important that I felt that I had to put it in. And it's only 4 pages long. That's the whole chapter. Very easy to read. And in here, I showed these charts, and this is all data from Nick Laird of those public depositories, the publicly reporting depository, transparent gold holdings, and it shows this sudden inflow of gold into the Commodities Exchange. If there wasn't that sudden inflow, so this began in March of 2020, if that hadn't happened, the amount of gold on the COMEX would have fallen to zero very rapidly. And by falling to zero, it means there would have been a force majeure, and then nobody knows what the price of gold is. A force majeure, the COMEX would have changed the rules, and commodities contracts for gold, futures contracts, would only be settled at that point in cash. You would not be able to take delivery of gold because they don't have any. It's a fractional reserve scheme. And what would have happened when they went to zero is anybody that actually did want physical gold would have had to go out onto the market to dealers such as me and try and source it through us. What does that mean? That would have meant 5,000, 10,000, who knows what the price of gold would have peaked at, because of that force majeure. And so there was emergency maneuvers, and the powers behind this are incredible. Because what happened is normally China is one of the largest, they are the largest importer of gold in the world. And now this is their imports, not their imports and their exports. So imports minus exports is the net. I'm going to show you, I was able to create that. These are Nick Laird's charts. But you see that suddenly with the pandemic in April, through April of the following year, pretty much, March to March, they pretty much shut off. In fact, when you include the gold exports from Hong Kong, these are just imports of Hong Kong and Shanghai exchanges combined. When you include the exports out of Hong Kong, this area actually goes negative, and you're going to see that in a moment. Now, is that because of the lockdowns? Is that because, well, maybe the trading was limited because all of the traders were locked down? Well, here's silver over the same time period. And other than this big outlier month back in 2017, you see that there's, a peak in 2017 and a big peak, and it's even higher except for that one outlier month in 2020, mid to late 2020.
The significant withdrawals, amidst a surge in prices, underscore the continued importance of precious metals as safe haven assets amid economic uncertainties. Gold prices recently hit a record and might not be done climbing. Some experts predict gold could rise to around $2,600 per ounce, yet others predict a reversal from record gold prices. How do you think the increasing demand for physical gold will influence global economic dynamics in the future? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.